So as we file the tax return, we give the results to the clients. And then the thing is, there's always more that we should be recommending. We shouldn't just be giving them the tax return only, that we should be making recommendations, because most clients who come to us who pay for services, they're looking for advice and suggestions, right? So even though we're almost finished the tax return, we could still make these recommendations right here called traditional or Roth IRAs. Okay? And what this is a retirement account that people could contribute into, and by contributing into that retirement account, you get a tax deduction for the previous year if you wanted. Okay? So let's go through what a retirement account is, because we want to be able to recommend to Taylor that, hey, this is your option if you want to save additional taxes. Okay, so it's important to know the key difference between a traditional IRA and a Roth IRA. What we'll do, we'll go through the details of each one, and then I want to make sure that we learn how to explain the difference to clients. So one of my main things when it comes to these trainings is that we not only learn the technical aspect of taxes, but how do we explain it to clients? Because if we're able to explain to clients in a very easy to understand way, it shows that you actually really know your stuff. With a traditional IRA, the way I like to say it is tax break now, and then with the Roth IRA, I like to call it tax break later. Okay, so two very distinct things. They're both considered IRAs, but one's a traditional and one is a Roth. So with the traditional, you get your tax break up front and pay no taxes on the money you put in until you withdraw it, okay? Meaning that when you put the money in, you reduce your income. Remember, we want to reduce the income as much as possible. So you reduce your income, but when you retire, like 30, 40 years later, the money you take out is going to be taxable, okay? So you get a benefit now, but pay taxes later. That's the way it looks. Now with the Roth IRA, the money you put into a Roth IRA, you don't get any tax benefits whatsoever, okay? If you made $100,000, you put $6,000 to a Roth, you still pay taxes on the full $100,000. But the benefit with the Roth here is that as that account grows over the years, anytime you take that money out after retirement, you're not going to pay any taxes whatsoever on it. So that's the benefit, is that even if you put, say, $10,000 into a Roth IRA and it grows to $1 million, that $1 million is not taxable at all. Okay, so that's the big benefit of the Roth. Okay, so we'll go through why one person might choose a traditional versus why another person might choose a Roth, because it really depends on various situations, and we're going to go through that. Okay, so I like this visual right here. Okay, there's three sections when it comes to taxes and tax deductions. Is traditional IRA, you get a tax deduction now. The money inside the account, it's going to continue growing because of investments and stuff and interest and dividends. None of that, as it grows, is going to be taxable as long as it's in a traditional IRA, okay? Because if you have a regular savings bank account and it earns interest, every year you have to pay taxes on that interest. But with the IRA, you don't have to do that. They call it tax-deferred growth, tax-free growth, okay? But the problem here is that when you withdraw from your traditional IRA, you do pay taxes on it. No matter, so if you put, say, $10,000 in originally and it grows to $1 million, when you take out that $1 million, that full $1 million is taxable, okay? While with the Roth, you don't get any tax benefit now, so you still pay the normal taxes. You get the tax-free growth just like this one, but the benefit here is that any money you take out at retirement is not taxable ever, okay? So really different way of whether you want the tax deduction now or tax savings now or tax savings later. That's the best way to think about it. So traditional IRAs, not anyone can put money into a traditional IRA. The rule is that you have to have earned income. So you have to have employee income or self-employment income to qualify to put into a traditional IRA. Same thing with a Roth IRA, okay? Can you earn too much to use it? So in general, a traditional IRA, there is no income limitation. So you could make $1 million and still put in $6,000 into a traditional IRA. While with a Roth IRA, there is an income limitation. So for single and head of household, once your income reaches $146,000, you're going to be limited on how much you could put into a Roth IRA. So one problem is that some of my clients who make a lot of money, they can't put into a Roth IRA directly, okay, because of their income limitations. So that's one of the problems with a Roth IRA, is that not everyone gets to contribute to it if their income is too high. But later on, we're going to talk about how to get around that. Okay. Can you use it at the same time as a 401k? So with the traditional IRA, so a 401k is a plan that you get through your employer. Not all employers offer it, so it's another retirement plan. We're going to go through 401ks later. But with the traditional IRA, it's usually meant for people who don't have access to a 401k. So maybe if their employer doesn't offer it, then they could put into a traditional IRA. But if their employer offers a 401k, it's usually better to put into the 401k over the traditional IRA. And then for Roth IRA, you could still put into a Roth IRA even if you have a 401k at work. And then is it tax deductible? For traditional is yes, for Roth is no, like how we talked about earlier. And then do you have to take out the money? So with traditional IRAs, there's something called a required minimum distribution. So once you reach the age of 73, the IRS makes you start taking this money out slowly, okay? They don't want you to just keep on saving it forever and then pass it on to your kids. They want you to start taking this money out at least slowly. So this is where the traditional IRA forces you to take money out, and you have to pay taxes on it when you take that money out. While with the Roth, there is no RMD, or required minimum distribution. You could just leave the money in there and leave it to your kids or leave it to whoever wants to inherit it, right? So you could open a Roth and just keep it open forever and never have to take any money out. Okay. Now, how do you get the money out? So usually with US taxes, 59.5 is when you start taking out from your retirement income. And when you take out from your traditional, it's going to be taxed, just like we said. And then here, you with the Roth, as long as you take it out after 59.5, none of it is taxable. There's no penalties or anything like that. Okay, but I do want to talk about what happens if you take money before 59.5. Okay, from either case, you're going to pay taxes and penalties. It's just treated a little differently. For traditional IRA, it's a little easier. If you're under 59.5, so most cases when people take out of their traditional IRA too early, before they reach the retirement age, is because of some kind of emergency. It has to be a really bad situation for clients who want to take this money out. So, because when you think about it, it's a 10% penalty plus it's taxable. And if you live in a high income tax state, about 50% is going to go to the government automatically. Okay, so that's where I always tell clients, okay, this is only a last resort. Try to find a loan, try to find credit cards, do whatever you can. Try to avoid doing this. This is only a last resort thing that we do. So usually this is like something really bad, like emergency medical or anything like that, okay? And then for a Roth, so as you put money in over the years, the original contributions you put in, because you never got any tax benefit from it, the IRS says, okay, that's technically your money. So if you take that money out, they call it the principals, the original contributions you put in, you could take any of that out and not pay any taxes on it because that's technically your money, right? But let's just say over the years, you put $5,000 each year for 5 years. So that's $25,000 you put in, but the account is maybe worth $40,000. Okay, you could take out $25,000 and not pay any taxes, but once you start taking out more than $25,000, they're going to start taxing it and penalizing the earnings portion. Okay. Okay, so this is a good visual. I like to share this with clients just to explain to them that the difference between traditional and Roth, and this is a timeline right here. So this goes through, okay, do you pay taxes now or pay taxes later? This talks about the growth, it's deferred, and then early withdrawal. So before age 59.5, what happens? And then when you withdraw after age 59.5, it's all tax-free or you pay taxes here. And then 73 is when you have to take the money out, but for Roth, you don't have to. Okay, so I personally like to use visuals when I explain things to clients. I like to present things to clients. Even on my trainings, I like to use visuals. I feel like it's a lot easier to understand, and clients actually appreciate it more, because using visuals to help you walk through the explanation is way easier than to try to come up with it on your mind, or even write it out in an email in text format. It's really hard to grasp and understand. But if you're able to show this visual and explain it to the clients with the visual, it makes things way easier to understand. Now, we talked about at 59.5, this part right here, where if you take money out too early, you pay a penalty. There's actually exceptions where you could take money out and not incur the penalty, but you still have to pay taxes on it. Okay, so you avoid a 10% penalty, but whatever your tax bracket is, if you're in the 24% bracket, you're going to pay taxes on that, including state taxes. Okay, so some of these things that allow to avoid the 10% penalty, and I think this is important to let clients know, is that when they hear that there's an exception, they think it's an exception for taxes and the penalties, which is not the case. We have to let the clients know that it's only the penalties that they're going to avoid. They still have to pay taxes on it. Okay, so it's still a big amount if they took a large sum out. Out of all these, the main one you're going to see is this one right here, first-time home purchase. This is most reasons why people might take out of a traditional IRA is because they want to use that money to buy their first home. So they could take out up to $10,000 and not pay a 10% penalty, but they will pay taxes on it. So clients need to understand that they will be paying taxes on that $10,000. So a lot of clients I've seen is like their mortgage broker or whoever told them that they could take it out tax-free. That's not the case, okay? So we have to make sure that clients are aware that they're gonna owe money on that. Okay, so with those exceptions I talked about, like especially the buying your first home to use the money, this only applies to IRAs, okay? So there's 401ks, there's other things called like 403b accounts. Those don't get the exceptions. So it only applies to if you have an IRA account, okay? The rule for contributing into a traditional IRA, there used to be an age limit where once you reach a certain age, you can't contribute. But now with 2020 and later, they changed that rule. So no matter what age you are, you can put into a traditional IRA now. Okay. This talks about what's the maximum you could contribute into a IRA. And for 2024, it's $7,000. But remember, it's based off of your total earned income that you receive, so based off of your employee compensation. So if you only made $4,000 from work, the max you can put in is $4,000, okay? But if you made $10,000 from work, the max you can put in is $7,000, okay? So technically the way you would see it as like you take it, you get to deduct the lower between the $7,000 or your total compensation. And are there income limits? There are technically no income limits, but there are income limits if the contributions are going to be deductible, meaning that if you have a 401k plan at work, then there might be some limits where you could put into a traditional IRA. Let's say you put $6,000 in, but not all of it's going to be deductible. Okay, so that's a little bit more complicated. We're probably not going to go through that because there's a whole calculation for that. But in general, letting clients know that if you have a 401k at work, just put into the 401k. Probably don't even deal with the traditional IRA. Okay, and then is there income limitations for Roth? Like we said, there is. So most high income earners won't be able to put into a Roth directly. So let clients know that, hey, because you earn $200,000, unfortunately, you won't be able to put into a Roth IRA. Okay, so for Taylor's situation, knowing that his income is $100,000, what would you recommend, traditional or Roth? So like I said, there's very specific situation depending on what you decide to do, whether you recommend traditional or Roth. Okay, and what you want to do is with the traditional IRA, you want to do a traditional IRA when their current working state, their tax bracket is high, but then when they retire, they think their tax bracket's going to be low. Maybe they don't plan to take out that much money at retirement. Okay, so the way I would explain it to clients is like, okay, right now you're in a 37% bracket. why don't you take the deduction at 37%, and then when you retire, maybe you're in the 10% bracket, you pay taxes at 10%. Okay, so that's a strategy when it comes to traditional IRA. Now, with a Roth IRA, you want to do it when your income is low and you expect your income to be higher later. So in this case, if your tax rate is maybe at 20% right now, but then when you retire, maybe you expect to be at 30%, right? So you want to be able to not pay taxes when you're in a higher bracket. So that's why the Roth is better. But what's most important is this right here, this younger portion. You want all young clients to contribute to a Roth, no matter what their tax bracket. Even if they're in the highest tax bracket, you still want them to do a Roth if they're younger. And the reason being is because with a Roth account, it grows over time, right? The younger you are, the more time it can grow. So if it keeps on growing more and more because they're so young, that means this account could easily reach over $1 million and none of it will be taxable. So that's why we want to make sure that young clients take advantage of the Roth IRA. And could be as young as 12 years old to even, I would say, 40 years old. Okay, so that's the timeline of young, is around up to like around 40. Okay. Now, what can we recommend to Taylor for 2025? So we finished his tax return. We recommended a Roth IRA to him. So he puts into a Roth. Remember, there's no tax deduction for it. So he's still paying taxes as normal like we did already. But at least he put money into his Roth. Okay, young guy, just got out of college, puts money into his Roth. Now he comes to us and says, hey, what can we do for 2025? Okay, we finished his 2024 tax return. What can we do for 2025?